Okay, good afternoon, everybody. We seem to have a slightly diminished audience from the last one, which is quite an animated and passionate debate. I don't know how many of you have stayed on. My name is Zachary Latif. I kind of introduced myself in the last talk, and I shall do so again, this time in a different capacity as moderator / chair. I'm a partner at TLG Capital. It's a PE firm that has a frontier market / emerging markets focus, and we invest in sub-Saharan Africa and Southeast Asia in particular. I have a very distinguished panel. I'll ask each of them to provide a brief introduction to themselves. That way they can do justice and let us know what they think is important that we should know about them. Could we start with, please?
Thank you so much. Probably the most important thing is I have Duke in my pool going all the way. So we got that out of the way. I'm Mark Chiaviello. I've been involved in Africa for the last 20 years or so. Originally started as a Peace Corps volunteer, and over the last 15 years or so, I've been in the banking side, commercial banking, investment banking side, as well as the broking side at Deutsche Bank. So I work now for Standard Bank, which is Africa's largest bank by earnings, by market cap, and we're in 18 countries.
Hi everyone, my name is Peter Thoms. I'm with Africa Capital Group. We're based in San Diego, and my interest in Africa comes from 30 years ago going to high school in Ethiopia and then taking many extensive trips to Africa in the decades since then. I went to a school for my MBA that I'm sure all of you hold in very high esteem. It's called Darden. And now I've come here to Duke to visit you. Thank you very much for the invitation. And we are investing in Africa and trying to get U.S. clients to be interested in putting money toward Africa. And that's it's an extensive education process, but we're finding good results and lots of good news coming out of the continent to help support our efforts.
Hi everyone, my name is Sindi, Mabaso Koyana. I'm South African. I'm an accountant and auditor. I trained with Deloitte. I've subsequently spent most of my time in the public sector in South Africa, basically in the finance space, being financial director of Transnet, the large transport utility across Africa, which owns South African Airways, the railways, the ports. I've been back in the profession with Ernst & Young, and 2 years ago the entrepreneurial bug hit me when I never thought it would, because I only saw myself as a corporate animal, and I am invested in mining services businesses, and I've actually put them together to form an integrated mining services offering. Thanks.
Hi, my name is Jamie Odell from Caravel Management. My interest in Africa started the day I was born. I spent my early childhood in Botswana and subsequently lived in Kenya for a number of years with my family, and then lived in New York, was an African Studies minor at college, and then after that worked for JP Morgan, including a couple of years in South Africa on the M&A side. I went to business school and then joined Caravel Management, which is an emerging and frontier markets focused hedge fund based in New York. We are global, so we invest in Latin America, Asia, Middle East, Central and Eastern Europe, and I manage the portfolio in sub-Saharan Africa. We invest only in publicly traded equities.
I think I'm going to just speak without a microphone because I can project. But I wanted to ask the panel, as a first, I've done this quite a lot as a panelist, so I want to kind of have a very engaged and active audience. So if you feel that you have a question that you can ask, do raise your hands and we will try to come through with it. I'm going to ask the panel a few questions that we can discuss among ourselves. Namely, I think the first one, which would be quite interesting, is what are the great opportunities in Africa right now that you guys are looking at and you think that on a 10-year investment horizon, would potentially be interesting, either in the PE space, public equity space. What's the big trade in Africa, if there is one, and why should investors flock there and go there? Anyone who would like to start off with that one?
So our big focus in Africa is the consumer, and we think that's the biggest opportunity going forward. I mean, if you look at some of the common reports about Africa, I mean, the McKinsey report points it out quite clearly that they expect the consumer sector to be by far the largest. So the opportunities really span a number of sectors. You've got banking, you've got financials, you've got the insurance business, which we think is going to grow pretty dramatically. There's food and beverage, healthcare items. So it's a long list of anything that a consumer is going to want in Africa. We're potentially looking at investing in that. The risk, though, of course, is that the young people in Africa that are now 40% of them under the age of 18, is that in 10 years time or so, they haven't really come through with employment. And so the expectation for the consumer to become the strongest sort of hinges on a much better employment picture coming through in Africa in the next 10 years.
I was thinking about actually, is it okay if I don't use the mic? Can you guys hear me?
Yeah.
Okay. Is that all right? So I would certainly agree with the sentiment around consumer. The way that we've built our business, and this is global, but I think it does apply to what we're doing in Africa, is around three pillars: financial services, consumer, and infrastructure. And I would just highlight that I do think that infrastructure, in addition to consumer, is one of the new trades, as you put it. I think that there is a realization within African countries over the past 5 or 10 years that in order to kind of get to the next level, investment in rail networks and ports, all of the things that Sindi spent a lot of her career on, that is going to be critical to unlocking the potential of the countries and the economies. And so whether or not you can play that through a number of different ways, it can be through the banking sector, which is providing a lot of the financing to those infrastructure projects. It can be through cement companies. It can be through ECP contractors. There are a lot of different ways to play it, but we think that's a very exciting opportunity.
No, please.
Sure. Aligned industries, obviously, we have found again is technology. I mean, the large infrastructure, transport infrastructure, has called for signaling, which is in the technology space. When you're looking at the railways, for example, you have seen integrated ticketing systems. I mean, the transport system in Africa is actually coming from a very, very low base. I mean, the taxi industry has basically been the industry that has serviced Africa. It is very disorganized, obviously, but the reality is that that's the one that kept the economy together. Now that we're moving towards a much more sophisticated state, so technology is becoming a big area of investment as well.
And last, what I would add, which doesn't necessarily have a very high barrier to entry, though there certainly are some, would be agriculture. I think Africa's, in many respects, Africa's great promise, which is being finally realized this century, right, is to feed the world. And you can have all the stats about how much is not under cultivation, the supply of water, how abundant it is. It's basically referred to as blue gold, and that would be both for feeding Africa itself. I mean, as you get more and more of a middle class, protein becomes more of an issue, whether it's beef or white protein, and then feeding the rest of the world. As China, as India become more affluent, their diet changes and more of a demand for protein as well.
Sorry, just to add something there. I mean, the luxury goods, we've been seeing how the demand for that has grown in China. Africa is coming along. A few weeks ago, we saw Porsche opening their first dealership in Nigeria. Your strong, expensive brands are actually becoming a force to reckon with Africans also wanting to believe that with their earning power, they can then delve away from the traditional space but into the luxury goods.
I think we've got like a few themes that emerge. Infrastructure is one of them, consumer, agriculture, and of course the two big things is technology and unemployment as well. So I think that's the sort of opportunities and challenges. But what is kind of interesting to me, and I think to the audience as well, would be that what are your thoughts on barriers to PE in Africa? Why isn't it on a more mainstream scale or on a larger scale? What sort of, I mean, we've all mentioned about sectors of interest. I'm assuming most of the returns that we're looking at are between 10 to 30% on an annualized basis. So why hasn't Africa been able to really develop that PE industry, and why is it fledgling until now, so to speak? And if anyone wants to tackle that or kind of provide a twist on that, but that's the perspective that I'm kind of seeing as well. That there is a growing trend, but the trend isn't where it necessarily should be at this moment in time. Why is that?
Maybe if I may pick up, you've got, you know, some of the large private equity firms internationally have provided a lot of research in that space. But one of the things that has been very interesting from where I'm sitting, having been at Transnet, for example, one of the large utility companies across Africa, and we ran the largest pension fund across Africa. In South Africa, there was a limitation for pension funds in investing in private equity because there was already a sense that it's high risk, high return. So pensioners, the last thing government wanted to do, because Transnet was a state-owned entity, and in fact the whole landscape on government pension funds, was to limit investment in private equity. So you could only use 5% of the pension money into PE. The rest could go in a larger content to bonds and equity. In 2011, it has been topped up, but again by only 5%. So I guess the fund flows into private equity are not as large as you'd see in publicly traded stocks. If I look at just the South African environment, because of the nature of the riskiness of private equity. Just to that.
I'll comment on that. Although you're the one that's probably best positioned to comment on that question you asked us. I mean, I'm not involved in private equity, but it seems to me as an outsider looking in that one of the big problems is that the funds are getting pretty big, and there's potentially a lack of, there's not enough capacity of companies there to take in all this money that's being raised for Africa, because it's, you know, the story is getting out there about Africa, whether it's a series in the Financial Times last week about it, or the Economist article, which was a couple weeks ago. The story's getting out, the funds are getting big, and it's getting harder and harder to put, so I understand, to put these sort of funds to work. But we should now ask the PE expert to answer his own question, I think.
I reserve the right to kind of just ask the question to someone else. But no, I mean, just as a general observation, I think the idea is that there is a saturation, but what I was also trying to get at more than anything else is that what we're also seeing within the African context is the difficulty of exits, and it's very. I think that remains a challenge for private equity, and even this is something that ties into public equities. That, you know, most of the time in traditional private equity, we would have an exit that would be ultimately a stock listing, but most PE exits which have been discussed tend to be strategic sale partnerships, and those. You know, those don't provide the same level of returns or have the same duration maturities as a public listing, public equity listing. So I think in a question, I don't know how the panel would want to look at this, but how would PE funds be able to circumvent the lack of a good exit in terms of their projects, and how are they looking to really capitalize their returns?
I think there's a couple of things. I think the equity is a critical part of the infrastructure story, and there's a lot of banks around that are quite willing to do the debt at different levels, but the equity is where it becomes difficult, and so that's where I think private equity is going to continue to play a role. Last year there was private equity deals with $3.5 billion in Africa, which was up 11% on 2011. But there was 2011 there was 39 deals, and then last year there was only 32 deals. So the deals are getting bigger, but less of them. And so I think what you're going to have to see on these infrastructure products is private equity coming, and then I think the sponsor of that product is going to have, of that project will have to develop the exit strategy, which would be maybe selling to a pension fund. A pension fund could end up owning a part of a power station in Tanzania, let's say.
Anyone else?
I mean, I'm also not in private equity, but I would say that I think the funding issue this is all growth capital, right? I mean, this is not about leverage buyouts, as you've seen in the developed world. And I think that there haven't been sufficient. I think there are a couple things. One, I think it's still just an early stage market, and therefore there haven't been the success stories out there to kind of have that demonstration effect. I think that also just within a lot of the African business environments or business communities, the concept of private equity is still one that's people are learning about and understanding better. Many of these entities, obviously, these companies are family owned. Many of them are state owned. And so those don't necessarily lend themselves to successful private equity until those sponsors become comfortable with it. And I think that not being able to have any financial engineering because the cost of debt makes it not so attractive. I think to a certain degree mitigates or minimizes the potential reward. And so I think that when people are looking at private equity opportunities globally, and they're looking at what the potential reward is in Africa, and they're weighing that against the risk, and then they're doing the same thing in other markets. I don't think for some of them they're not getting the same level of return that they feel they need to get.
That's very interesting. I think before I ask the audience if they have any questions, just a more generalistic one is that we had a fairly heated panel discussion in the previous panel where the Prime Minister, who's quite a character, he asked that the idea of looking at Africa with profit needs to be revised, and there was something that I think we finished as an unfinished rule, so to speak. And for me, it's from my perspective, it seemed a bit interesting to explore that. How are foreign investors or how are external investors supposed to look at Africa? Is it just as a way of somehow producing profit from the continent, or is it meant to be a considered general social approach, or what is exactly the right balance, and what sort of sensitivity is required? Is it more or less as compared to any other region? Because that's what in the last discussion, that was where we ended off, that Africa deserves a new consideration. And I just was wondering, on the finance panel, what those thoughts would be. Is greed good, or does greed need to kind of be changed?
Well, greed can never be good, but at the same time, business is business. Capital follows returns. I mean, there's scarce capital, both financial capital and human capital, which must also move along with technology. So the reality is that foreign direct investment would flow where there is reasonable expectation of the returns. And the International Financial IC, their recent results have demonstrated that their investments in private equity, they have seen returns on average over the last 5 years of about 21%. In fact, when you talk about the risk of exiting, those are real. There are risks in exiting, but there are areas where they have had successes. A federal steel company has just been sold by a private equity firm, where they realized 74% of return. So I think when we're looking at Africa, we do expect people to understand the landscape. And when we're asking them to understand the environment, we are talking about skills transfer, because we're coming from a low base of certain skills that do not exist in the African continent. To say, once you do business, you need to invest in the skills. Once you do business, you need to nourish the environment where you are actually getting your profits from, but not necessarily to say there has to be charity. But at the same time,
we need to look at the profits that are expected. I mean, the 74% profit that was made by the exiting private equity in the Federal Steel Company, you know, one would wonder what they left behind in terms of their tenure and how conscious and conscientious they were in terms of giving back in that environment. So for 74%, you'd expect that some of that should have been shared during that time with the communities.
And as you know, we're Center Bank. We're in, as I said, 18 countries, and we employ about 45,000 people. So one of the things that we look at is that we have to be relevant in the societies that we operate in, and that really kind of starts right with the bank itself. You know, 6 years ago, 7 years ago, we estimated that 6% of us were HIV positive. So what were we going to do about that, right? So we put in a big workplace program in that, and it's actually turned out to be an award-winning program where I think we've really kind of changed the dynamic of the discussion of HIV in the workplace, at least in Center Bank. I think maybe in a broader sense in Africa as well. And the mining companies have done similar things. But moving on from HIV, malaria in Nigeria. We have a big business in Nigeria. We really kind of bet the bank on Nigeria. And we think in Nigeria, we estimate that at any given point in time, that a third of our employees are affected by malaria. Either they're homesick, or they're sick and soon to be home, or somebody in the family is sick and they have to stay home. So we make a big commitment to bed nets and education and training people on that. So it's really, you know, operate. You know, there are issues, and you have to embrace those issues if you want to be successful. Unfortunately, you know, our earnings were only up 10% last year, so I don't think anybody can complain we're gouging anybody just yet.
I just wanted to ask you, betting the bank in Nigeria. I mean, just you know, just as a sort of a slight diversion, what do you mean? Like, what is the expectation for Nigeria? You know, in terms of as an economy, as a business growth area, why Nigeria of all places?
Well, a number of reasons. I mean, there's 1 in 5 Africans are Nigerian, 1 in 8 black people around the world are Nigerian. So we think it holds huge potential. Jonathan Goodluck has done a lot of good things. The Reserve Bank Governor Sunu. And everyone looks at Nigeria as a very corrupt society. But what you have to remember, and I think it's an astonishing fact, is that the Reserve Bank governor was the only Reserve Bank governor in the world that put bankers in jail after the debacle of 2008. Okay? Only governor in the world. And he's one of the first people that really have spoken out on a number of other issues as well. So we think Nigeria, for a host of reasons, the number of people, the opportunity from a pure banking point of view, that as those folks enter the formal banking society, holds huge opportunity. I think we all kind of know the story of the natural resources in oil, but we'd argue also in agriculture as well, where they've done quite a bit in agriculture over the last couple of years.
And you've got the numbers in Nigeria.
I got the numbers.
The 200 million people in Nigeria in just one country goes a long way from a consumer point of view.
And also, I think what's interesting is that we were touching on this. I think I was touching on this with Jamie. Is that the idea of retail, like for instance, American retail investors, or forgetting Europe for now, but American retail investors. There is this whole idea in the news that there is a rising economic story in Africa. So how would any retail investors actually look to get involved or profit or get engaged? Is there a mechanism right now for anyone who probably has a 501k account, 401k account, I think they say, to actually be able to parlay some of their earnings or some of their investments into the continent as well? I think that's something, you hear of a rising story. There are ways to get into China, but what are the ways to get into Africa?
I'll take that one. There are very few right now. I mean, there are a couple exchange-traded funds that you can buy, one by Market Vectors and another one that tracks the MSCI South Africa Index. And there are a number of, there are probably 18 or 20 ADRs from South Africa that trade on the New York Stock Exchange. So in terms of if your trading is limited to the U.S., it's pretty limited as to what you can do to get into Africa per se. So the retail investor has that problem. I mean, that's one of the reasons we're in business. I mean, the problem we're trying to solve is that we have an account that a U.S. retail investor can open. It's a U.S.-based account, but we're trading African stocks with that account. So it's also a question of not only the technological challenges of doing that, but overcoming the perception of Africa as a very risky place. at the same time that you see these articles about how Africa is rising, if you look at the front page of the New York Times, I mean, at least once a week, there's a grim Africa-related picture on there, whether it's an infant that got hit with a machete in the Kenyan election in 2007, the violence after that, or the problems in Mali, or the shootings in South Africa at the mines. It's a steady, unfortunately, a steady diet of bad news that's sort of in the broad press. And if you dig deeper in the financial press, well, yes, then you'll discover that there's actually a good underlying growth story going on there. But in terms of what's on offer for U.S. investors, I mean, it's pretty grim. If you can trade in London, then you've got probably access to another 100 or so companies that are focused on Africa, but probably 95% of them, or maybe 90% of them, are in the resources sector. You know, they're exploration and production companies operating in Africa, perhaps based in London, trading on the London Stock Exchange. So yeah, the pickings are fairly slim, and that's why we're going into that market, not only to educate people about why you want to do it, but also make it easy and transparent for U.S. investors to get that exposure.
And those exchange-traded funds are out of New York Stock Exchange?
Yeah, the exchange-traded funds are. And there's supposed to be a couple more coming. Market Vectors, which is an ETF company, has been promising the Nigeria ETF for quite some time, and I call them up to hound them about it every once in a while, and they say, well, we just haven't made any progress on that. So it's very difficult to get these, if you want local Nigerian stocks, but accessing them through a U.S. traded vehicle, it's just difficult. I mean, you do have a couple of Nigerian stocks that trade on the London Stock Exchange. Guaranty Trust Bank, for example, which is a big bank and one of a ferocious competitor in the euros, I imagine, in Nigeria. But yeah, it's the modes of getting in there from here in the U.S. Surprisingly, they're kind of limited.
Sure. I mean, I have two questions. Sorry. No, go ahead.
All right. Yeah. Sorry. Staying on that, I'm just curious if both Peter and Jamie could actually speak a little bit more about how you're playing the public equity markets there. Like, what percentage of your trades go through Nigeria versus South Africa or where else? And then if there's not enough meat there, talking about the constraints, are you doing any sort of shareholder kind of proxy battles or anything like that, or is this just a purely public equities sleeve?
So with regard to what we do, we invest only in publicly traded equities on the local exchanges. So we don't really use GDRs. We do have one London-listed company that happens to also be listed domestically. But otherwise, we're dealing with local brokers, and it is, to be perfectly frank, I mean, it is a challenge for others, and that's one of the competitive advantages that dedicated Africa or dedicated Frontier or funds like ourselves have, is that the complexity of trading in these markets does serve as a barrier to entry to UCITS products, to mutual fund products, most of which are, I think, partly because the liquidity issues are so significant, right? So having a product that has daily liquidity where you can get in and out just doesn't work in the African, or at least in the sub-Saharan African context. South Africa obviously is a totally different market. With regard to sort of our approach, it's a passive approach, so we don't invest, we don't take majority stakes. It's rare that we have more than a 5% position, across our fund. It's generally about 0.5%, 1% of the free float that we invest in. So we do take small stakes, and the activist mentality or approach is not the one that we've seen yet. We'll provide help where we can to our portfolio companies if they want strategic advice and they want to talk to some of their larger investors about some things that they may be considering, or maybe they want to talk about access to funding, from U.S. sources. Let's say we can help them navigate that a little bit. But we buy high quality companies that we have a lot of faith in the management. We like the strategy, and we're there to help them if we can. But we're really buying into their story.
Just on that point, Ernst & Young has also just completed an exercise looking at SDR of the last 10 years. the picture there is actually interesting because the U.S. is the largest, the flows come mainly from the U.S., followed by France, then the U.K. And in drilling down to some specifics, in the last year we saw Walmart buying into an equivalent back in South Africa, buying 30% of it. And we saw how long that took because there were ramblings around the Competition Commission, labor, where they wanted guarantees that Walmart would not come in and coming and putting it, revise efficiencies and retrench people. So the labor market got involved and that got delayed, for some time. We've seen IBM also investing. Walmart's amount was about $1.2 billion. IBM, because of Barclays buying into, with Airtel and their participation in Africa. So IBM has then further invested $300 million so that it can support the party's technology support in Africa. Alongside that, when they unpack it, it's mainly oil and gas, which is predominantly around Nigeria. But the U.S. has been the largest input into Africa on NPR.
I'll take you. This is more to Peter, because you mentioned you were trying to raise money from the United States. Can you talk about some of the concerns that people have around transparency risk, or in the case of a public company, the liquidity risk, or how liquidity might dry up and you may not be able to pull the money out, or even currency risk? Could you talk about how you mitigate some of those from your own perspective when you're trying to raise money in the U.S. or in Europe?
Right. I mean, so one of the main things that U.S. investors are concerned about is the transparency aspect of things. I mean, there are obviously with the hedge fund blow-ups, not focused on Africa, but just hedge fund blow-ups in general, people are very skeptical now. And so what we've done is we've taken an approach where we're having a separate account for each client. So each client puts money into their account, it's got their name on it, and then we trade within that account, and it actually settles in the U.S. and U.S. dollars. So what that does is it gives them the comfort that they can go and look and see what they have there, and they can, they own the underlying stocks that are in the account. And so it gives them that level of transparency. I mean, the downside is that the universe is not as big. We don't have access to the full range of countries that we would like access to. So there's sort of a trade-off that you have to make. I mean, there's no one silver bullet that's going to get you, exposure to all of Africa in a very easy, transparent way. And in terms of mitigating the risk of actually what's in the portfolio, is in many cases we invest in companies that have businesses in many different countries. I mean, Africa itself obviously is very large, 54 countries, and so if you're invested in a lot of different places, you sort of have quite a lot of diversification built into your portfolio. So problems in Mali are not going to affect, a business in Botswana, that sort of thing. So that's what we try to put to our investors. But yeah, I mean, is it risky? It's risky. And we make sure that they know that up front. And most of the people that doesn't scare them away because they're reasonably sophisticated and they knew that before they wanted to get involved. But so they're just putting a portion of their capital, and the people that we deal with, for one reason or another, have some affinity for Africa, and that's why they want to be there. They don't need to be there, but they want to take part in the growth.
If I can just add to that quickly. The three things that we hear most from our investors, their concerns really are around political risk, transparency and corporate governance within the companies themselves, and just sort of corruption in general, and then currency risk. And so for each of those, I'd say, on the political risk side, a lot of our due diligence is around the stability of countries and where they are in an election cycle, how well or how risky we feel they are to some sort of a coup or some other unfortunate political event. But in general, that's something that we feel like can be represented or can be reflected in the risk-adjusted upside that we look for. from a transparency and corporate governance perspective, again, that comes down to due diligence and meeting with the management teams, and we each also have good networks within the countries to be able to evaluate whether or not there are particular sponsors or families or groups that have histories of maybe not respecting minorities, minority shareholders. And so that's something that we focus on as well. But it's not something that's been an issue for us. So in our 8 years of existence, we've never had any problems with fraud or corporate governance issues. I mean, a country like Zimbabwe, the annual reports that come out of the country of the companies like Delta and Inscore and Econet, et cetera, all audited. Some of the most detail that you'd find almost anywhere in the world. So certain countries have a regulatory environment that's also quite a lot better than I think people expect it to be. And then just on the currency side, I think we're not currency forecasters and we're not macroeconomists, but we do look at sort of the core fundamentals of a country's balance sheet, current account, fiscal deficits, relative levels of leverage, as well as reserve levels. And for those countries that are more vulnerable to weakness in the currency, we'll just make sure that A, we're being compensated for that in terms of our risk-adjusted upside, and B, that we're weighting our positions appropriately there.
Avant Capital, which I think is a US-based private equity, has also just given an analysis on the transparency index. And actually, South Africa, Namibia are better transparent than China and India. Obviously, then have Angola, DRC ranking way, behind and badly. But you do have, so it's a mixed bag in Africa. So you can do your research very well in picking certain of these countries that are fast growing and have got the opportunities and be able to zero in your investment in those areas. And because most of the projects are developmental in their nature, the risk has been mitigated because a lot of DFIs have been willing to go in together with private equity companies. In fact, a recent one as well, not so recent, but in the telecom space, Helio, the tower manufacturing guys, they invested the first tranche in 2005. IFC followed them, and I think the Soros Strategy Fund with Rothschild followed them at that stage. Their returns have been quite good, and now they have scaled into Ghana, and I think one other country in Africa. And then IFC again has followed together with Rothschild. And for them, they are saying the risk gets a bit mitigated if there is a DFI that knows the country and has navigated its journey within the continent.
Please.
I have two questions. Number one is, what is the rate percentage rate for private investors? What is it, and is it across the board or just to a particular country? What is the rate? If I want to invest now, what should be my rate?
The rate of return?
Required rate of return?
Rate of return, yeah.
For a private equity?
Yes, private.
Different funds set different hurdle rates for themselves, depending obviously of where their own capital is coming from, based on their own shareholders. So it varies. But we've seen mainly that we move between 15% and in some instances up to 30%.
What about for public?
What is the required rate of return? I mean, it's come down across capital markets worldwide with rates being so low now. I would say, again, it varies by the client, but I always try to talk them down from, if they're looking for their 20%, I always try to talk them down and pour cold water on that. Also because Africa has done well lately. And things that have done really well lately tend not to do so well for at least a while, maybe. We play some catch up. But as far as a number, I mean, I would say, like low double digits over a full cycle is what you would be. I mean, I'd be.
We're shooting a little bit higher.
I'd be pleased with that.
I mean, I agree that you have to look at over a 3 to 5 year period. You can't think about returns in this market on anything shorter than that. I would say, though, that if you look at sort of just the underlying companies in our portfolio, their EPS growth over the next 3 to 5 years should be, we believe, 20 to 25%, right? So if you don't believe that those companies are significantly overvalued at this point, you should, in theory, over a 3 or 4 year period, earn a roughly 20% return. And we feel like that is, that's an appropriate level of return given the risk, given the volatility. But figuring out what is the required rate of return and the discount rates that we use is, I mean, we could spend an hour talking about it. It's a very complicated and very subjective in many cases issue. You've got countries that we invest in that don't have any yield curve, right? How do you evaluate what is the risk-free rate of a company, or rather of a country? It doesn't really have a fixed income market, even a government bond market. And so you have to use, you sort of have to triangulate based on what you believe the risks are in that country, what the inflation rate is going to be, what interest rates are like, or what bank lending rates are like in that country, and compare those sort of within countries that you think are similar to develop your own sort of internal discount rate. Something we spend a lot of time on internally.
Yes, let's go with that.
One thing that I've heard in both this panel and the last panel is that's a bit disconcerting, is that there's a lot of big investments that are being made, and not so much like small. I think Sindi, in the last panel, you spoke about small component and like sort of maintenance projects that could be in line for Africa in terms of investment. How do you guys feel about microequity and microfinance projects and like the potential for those being created, or those opportunities in Africa? Do you see any potential there, or
well, we do quite a bit, and we just started quite a bit over the last couple of years in the small and medium enterprise space. And the issue is, as a banker, right, that there typically isn't collateral that you can lend against, right? The collateral really is the woman and her stall. Right? And you're going to take the stall, you're not going to take the woman, right? So what do you do? And so we've worked with some universities here in the U.S. actually to develop a unique set of questions that we ask, and the results. Though it's still early days, the results have been quite good. That people's willingness to pay back is not really based on much on their capital and on the vibrancy of the business, but really the humans themselves. Right? They're going to pay back. And so we've done, as I said, we've started doing more and more work on that in places like Kenya, Nigeria, and the numbers have been pretty good. And we would argue that SME really holds great promise for Africa, and I think that's starting to come to fruition. But finance, if you look at the studies, finance is actually second or third of the most critical issue that an SME will face. Number one is electricity. And so that's electricity.
You're quite right. The average private equity fund, there's about 160 private equity funds across Africa, and the average that project that they'll invest in is about 200 million if you actually put that together. So what we find is that governments have then taken it upon themselves to be enablers. In South Africa, for example, there are a number of enabling institutions for SMEs because the government has realized that that is where employment will actually come from, instead of the publicly listed companies that are very conscious of their efficiencies and costs. So rather develop as many entrepreneurs as possible. Yeah.
This is a really good discussion. And then I'll take you on.
Question. What I'm hearing right now, you guys, your Americans here, they're investing in Africa, in all that stuff. What have you thought about us? We have money in Africa. Why don't you take our money and do the same thing to benefit us Africans? Because right now you guys are taking money from here, we have big companies here investing in Africa, you're snatching the money out and bringing it back to the US. What have you done for us as Africans? We have the money, we don't know what to do. Why don't you help us to run our, I mean, we don't want you to run it, but we'd love to invest too in the US. Have you all done that project yourself? Have you all looked into that project?
I'm not sure I understand the question. So what?
What I'm saying, you guys, you're investing in Africa. Right now you're taking equities and buying stocks, whatever.
Right.
We have money in Africa too. We'd love to invest in the US too. Have you all done that for us?
No, you can give you a way to invest, for Africans to invest in U.S.?
Yes.
You know, it's actually a business idea I've thought of in the past, but I mean, we can only do so much at one time. But certainly, the level of wealth in Africa is going up, and the
way I look at it right now, it's all about trade taking from us Africans and bringing back to the and we're not benefiting any. I mean, you understand what I'm saying, sir?
No, I absolutely understand, and I'll just say something from my perspective. In London, I'm going to step out of my moderator role, but just the thing is that actually, I mean, this panel has had a very interesting discussion, but I would also say that a lot of high net worth Africans, and this is what we have also seen, are not necessarily interested in reinvesting their money back into the continent. Rather, they are very savvy in the sense that a lot of their wealth generation is redirected back into safe havens. So, as an example, the London property market is actually buoyed to some extent by very high net worth Africans. So it's not that somehow they have an issue with capital transfers. In fact, if anything, I think the key question is having the high net worth Africans reinvesting back into Africa as opposed to trying to always look for a safe haven. That's my perspective. I leave it to the panel if they want to disagree or argue with that, but that's just something we have noticed.
I won't disagree with that. In fact, we've seen even, I mean, black South Africans look at Cape Town, for example, in South Africa, as if it's another country because it's almost separate from the realities of a country that has a diversified, is a diversified nation. As a result, we've seen a number of high net worth individuals from the rest of Africa coming to buy property in Cape Town that most individuals in the country can actually not afford. So that is definitely not perfect. But talking about why aren't Africans allowed to also invest in great assets outside of Africa? Again, when I was with the public sector, where there are large pension funds, where some of the pensioners were starting to look for diversified assets, we would actually go on road shows and meeting other hedge funds in the US to see if we cannot diversify the investment portfolio of large pension funds in Africa. So it is a situation of supply and demand of and the interest of the investor. You are allowed to invest anywhere you want to invest. You just find a financial advisor or a broker that can actually scan the market for you.
The way I look at it myself, you know what I'm saying? It's all about Africa. We're trying to build Africa itself, you know what I'm saying? It's all about trade. If there's trade, nothing is going on. There's no growth going on right there. Right now, they're snatching the money and bringing it back here to the US. And why can't we, Africa, as you guys, why can't you guys sit down and say, okay, you guys want to invest in Africa, help us who want to invest in the US too. We have to look at, because it's one-side scale right now, the way I look at it. It's not balanced scale for us Africans.
Let's circulate around a bit. That's noted. I think I'll take you first, and then because I remember that you raised your hands first.
My question would actually resonate to the last questions, and just for clarity on behalf of the panel to you as well. As regards to consideration for them investing in Africa, you need to understand the thin line between
actually investing and actually wanting a return or yield on your investment. Okay? There's so many factors that could actually be considered to consider capital investment firms investing in Africa. There's a balance system already in place for them to actually be there in the first place. Okay? Other factors that actually is essential towards their continual investment in Africa is determined by factors which Africans need to basically awaken themselves to. So I'd just like to make that on that note. However,
why don't you, because I think we are not able to hear you, so just take the mic and speak into the mic.
Right. So
the bottom, yes,
it's interesting to see the references some of the capital firms have actually made to Nigeria. And likewise, it's known, okay, one of the major sort of resources in Nigeria is oil and gas. And that, for sure, seems to be the main focus for most capital investment firms. Now, equity, at the same time, collateral is a major concern. Now, I would like to know which steps you're actually taking to diversify your portfolio beyond just the energy and gas industry and actually invest more in other sectors. Likewise, it's against focus on major corporations who already existing and standing alone pretty much and just need capital investment to expand their businesses. What structures and focus are you also putting into place to at least identify not necessarily set of businesses, but viable businesses, and what conditions, what flexible conditions are you actually putting in place to really identify this opportunities in firms? And right now in Nigeria, for example, there's a lot of push from the government for PPP transactions and opportunities. I'd like you to speak a little bit on that. What considerations are you really putting into that? And what processes would you rather want to see in place for you to really put a consideration on most of those government-offered PPPs?
I mean, in summation, it's sort of like how would you build an investment process that looks beyond obvious and extractive sectors like oil and gas, but rather into more sustainable developmental industries like consumer markets. So how would, I guess the question being asked is, how do we look into more consumer market investing?
Yeah, because, you know, we don't invest at all in, well, we can, but historically within Nigeria, we've never invested in the resources or the oil and gas space. We've invested only in consumer, financial services, and cement spaces. And so we feel, you know, to a large degree, those are the sectors and areas that we think have actually the greatest potential for growth. If you look at the oil and gas sector, you probably know this better than anybody. There actually hasn't been any growth in that market within Nigeria over the past 5 years. There's been very little investment. They're going through now a process of you know, trying to restructure the petroleum industry laws, but that's going to take a little bit of time. And I think once that's done, there will be greater clarity. I think we will see greater investment in that space. But for us, we really think the future is in the infrastructure, the financial services, and consumer areas.
And we would say, I mentioned before, in agriculture, the Minister of Finance and the Reserve Bank cover has put a fund available that banks can borrow, can use to then lend on to the sector. That's still early days, but early days indicate that's been quite successful. And I know Stanbic IBTC, our operation there, has tapped into that fund to lend on. And we think agriculture, as I said, will be the promise in Nigeria. And what you're seeing as well, not so much from South Africa, you know, you're seeing a number of the banks have gone up there. You know, we went up there a number of years ago, and then I guess it was just before the previous election that we put $500 million of our own money to buy 51% of IBTC. Big statement. That was 2 elections ago. Big statement. And that's how committed we are to the time. And I think you're seeing the same thing now with other banks from South Africa going up there. I think First Brand has just done something a couple of weeks back. And then also the consumer companies, you know, Massmart, ShopRite from South Africa, are all it's a huge opportunity. Lagos is a fascinating place. It's a huge opportunity.
From a government point of view, just 2 examples in South Africa, because I heard a question saying what is expected from the government to enable investors to come into other industries. The construction space, road construction, and even the railways. I think somebody repeated this point that I made in the last session, is that government then subsidizes, for example, the cost of usage for the toll roads, where the community, the public, would have an outcry of saying what the developer and the investor is expecting as a return to charge, every toll user is not going to be sustainable or cannot be afforded by the community. So government then gives the developer an amount of money to subsidize so that the individual consumer doesn't have to suffer, and also the investor doesn't suffer at the same time.
I think we probably have time, another 5 minutes or so.
Well, I thought it was interesting that you said some of the high net worth Africans are investing outside of Africa, bidding up properties. So I'm just curious, do you have any comments on why that might be? Is this a diversification tactic, or are they just getting their money out for another reason?
It's lifestyle, and to some extent, to be honest, it's probably how the money was acquired, and not wanting to be put to scrutiny if you are able to actually acquire such property in an environment where there's a big gap between the rest of the population and yourself. So you're seeking a lifestyle where you can enjoy that kind of opulence without being brought to question. So in some instances it's because it is really well earned, and in other instances it's because they don't want to stand up to scrutiny.
The other side of that, which we haven't touched on, and Brenda Meredith's not really on this panel, but is the diaspora coming back, which we think holds, once again, a huge opportunity. And in our bank, we see it as a great playing field to really get top talent into and we've seen quite a bit of that. A number of senior folks in our bank now, and not so much in South Africa, but in the rest of Africa, that's where
we've talked a lot about kind of the broader, demographic and kind of fundamental shifts happening. We've talked about some of the concerns in investing in whether it's in the private equity space or public equities. I guess more broadly, I'd really be interested in hearing all of your opinions on what does it take to succeed in this space? Is this just kind of a rising tide that's going to, as long as you get in, kind of like everybody is going to make money? Like what does it look like over the next 10 years? How do you kind of differentiate yourself?
Could we just, that's an amazing question. Does anyone else have a question? Because I think what we're going to do is we'll make this because there's some time for closing remarks. So let's keep that in mind, and then we can just cycle through each panelist because that's sort of like a good macro question, about Africa. Is it a rising market? What does it take to succeed? And then if you want to also end, and what parting shots you would like to leave with the audience to also meditate on. So kind of do that as a duel, and we'll start with from the beginning with Jamie, and then work all the way down to Mark.
So I actually, I don't have any closing remarks other than to say that I've really enjoyed this session. It's been a great set of questions. I've enjoyed hearing the opinions of my colleagues here. But I actually would like to take you up on your question a little bit. And if I understood it correctly, do you mean in terms of as a professional, or just sort of from a more broader economic perspective?
As an investor.
As an investor. So for me, and I'll repeat a little bit of what I said during the last session, but for us, deep due diligence is critical, right? You have to understand the markets in which you're investing. You have to understand the economics. You have to do a lot of work on companies, both to understand the management and the sponsors, but also understand how they're really going to grow their businesses and how they're going to grow them profitably. What I said in the previous panel was that it's easy to find companies that want to grow. It's harder to find companies that can fund their own growth. And so for us, finding those high-quality businesses that are highly cash generative and have very low leverage, that have a dominant market share and some sort of structural competitive advantage, those are the ones that we think are going to succeed over the long run. And that can be in a number of different sectors. We're fairly sector agnostic. But that's the type of profile that we're looking for. And with respect to the types of countries in which we're investing, we have a fairly large footprint. We're in a lot of different countries within Africa. But understanding as dollar investors where you're going to get the highest risk-adjusted return on a dollar basis. What I mean there is where is the highest likelihood that the currency risk is going to erode those returns. That obviously is a paramount consideration for us as well.
Sindi, if you want to just pick up on that.
Yeah, I think in closing, one of the things obviously that I thought was going to come up with the question around the political stability and in South Africa yesterday. I've got a lot of questions around the labor protests that have been happening in South Africa, especially in the mining environment. And I think one of the things that are very clear around South Africa is that there are pockets of regulatory policies that are strong, and obviously in some areas there is still a lot of work that needs to be done, because we can't profess to say the environment is perfect. There are certain challenges that are being faced both in South Africa and across the continent. However, there is a conscientiousness of understanding that these need to be nipped in the bud, because the labor unrest in the mines have come because I think labor for some time in South Africa has been very inflexible from a point of an investor point of view. And I think they've been given some leeway. We came from an environment where in the past labor was seen to be abused, and when the laws came in, there was too much leverage given to the labor community. And I think as a result, we're starting to feel the pinch around that. But government, who has been held at ransom because they know that a large contingent of the ruling party was patronage from the labor movement, and that's what supported the ANC in winning the government. But they now realize that in giving them too much of a leeway, we will take a bit of a knock. So there is pushback again now coming in terms of managing the labor situation. But it is a challenge right now, and everybody's aware.
So you asked a pretty broad question. I think the most important thing for anyone considering getting involved in Africa, either as an investor or going there and maybe starting their career there, is just persistence. Because a lot of the stuff that happens, it just takes longer, it's just more difficult, and things happen at a different pace. And so I think that relative to what you might find here, a career in the U.S. is that you're just going to have to be more patient and keep working whatever issue you're working. And that's really the best advice I would offer to someone who's considering heading off to Africa for a career.
And any closing?
I don't really have any particular closing remarks, but I've enjoyed the session very much. It's my first. I understand it's the second conference, a lot bigger than last year. So obviously you've got a lot of momentum here, and it's great to see a lot of people here interested in Africa.
Well,
first of all, I want to great comments on labor, and very well put. There's a long history of the labor issue in South Africa, and it's an evolutionary process. But to answer your question, what we talk about, really what we kind of come to with the punchline, is that we say, I work with 45,000 Africans that are there to create an African solution for an African issue or opportunity. And that's really, I think, if you're looking to invest in Africa, is that you want to make sure that your partner, your colleague, is a good one, right? And there are a lot of good ones, right? There's a whole lot of good ones. And that's really where the solutions and the answers come from, not from Park Avenue where our office is, certainly not from the City of London or from the District of Columbia, right? Those answers aren't going to come from there, right? The solutions and opportunities are going to be addressed by Africans for Africa. And that's what we really bet on at the end of the day. And that's what we sell hard, is 45,000 Africans creating solutions for Africans on African opportunities. So in short, it clearly is I think the century for Africa. One of the closing comments we always give is that by 2040,
the UN believes that or UN estimates that there will be more working Africans than any other continent in the world. Right? More working Asian Africans than we'll see in China. Right? China is going to grow old. It might not grow rich. There might be a bit of problems with China. Africa might not grow rich, but there's nowhere on the horizon you can argue that it's going to grow old anytime soon. So from a consumer point of view, we would see it as a huge, huge opportunity.
Okay, thanks very much, Mark. I'd like to thank our really great panelists. It was a really value-added session. I learned so much of Jamie and